Good morning and welcome to this Monday, March 20th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got another week underway. Normally, the Monday after options expiration, not normally a good day. We're going to talk about that and a few historical facts a little bit later in the show. Just going to jump in here and take a look first at the futures. Right now, we've got Dow futures up 116 points, S&P 500 futures up about 12.5, NASDAQ 28. That was as of about 10 minutes ago. Crude oil down another 43 cents a barrel. It is at 66.31 per barrel. That is down about almost 0.6% today. And that comes on the heels of a pretty steady drop last week in crude oil prices, dropping back to its lowest level since back in 2021. The 10-year Treasury yield earlier this morning was down below its double bottom that we've talked a lot about, which was down around 3.37. I saw at one point we were down to 3.35. I'm not sure if we got any lower. But currently, the 10-year Treasury yield has bounced back. It is now up 4 basis points, 3.44%. So that's going to be an interesting development, watching the 10-year Treasury yield this week, especially with the Fed coming up on Wednesday, likely to raise 25 basis points. That's the consensus. I don't think they should raise, but that's just my opinion. We'll see what happens on Wednesday. I do think that with everything going on between the banking issues that we've had the past couple of weeks, taking a look at the inflation reports and what the Fed's been talking about with inflation, because I see inflation, PPI was very, very negligible last week. CPI actually came in a little bit, just slightly hotter than expected on the core level. The headline number was actually as expected. And so what's the Fed going to do on Wednesday? I think that's a big question mark as we go throughout the week. And it's not just what they do, but what do they say? If they do raise a quarter, are they going to change their language and talk about what's going on in the banking world and, the fact that maybe they may have to pause for a while, or do they just ignore it and essentially say, hey, we're sticking to our guns here. We're going to keep raising as long as we feel the need, blah, blah, blah. But how the market reacts to it, I think, is going to be the key. There's very little this way in terms of this week. There's very little out this week in terms of economic reports. There will be some earnings reports, but really it's going to be about the Fed and it's going to be about technicals. And right now we've got the Dow and the S&P both looking weak, the NASDAQ looking better, mid caps and small caps challenging lows from a few months ago. So, it's kind of a all over the place scenario right now. And then we've got the historical trends that are telling us to be a little careful this week. So a lot going on, but anyway, that's the whole idea. Let's take a look at what's going on. So let's go ahead and just jump right in to the daily market recap and what happened last week on Friday. So the Dow Jones Industrial Average was down 1.19%. S&P was down 1.1%. NASDAQ down about 0.75%. But look at mid caps and small caps down 2.3% and 2.75%. And of course, the volume's always heavy on option expiration day. If you look, the third Friday of March, June, September, and December, volume is always going to stick out like there's something big going on. Well, there is. It's option expiration. So you get a lot of folks that are trading out of certain stocks and moving to new positions or extending their contracts out a few months or a couple of months. So there's just a lot of shares changing hands on option expiration day. But again, if you look at these, what just transpired and what's been transpiring, we've got a little bit of differences going on here. Since mid-February, and I talked about this in mid-February, and I've been talking about it since, The stock market historically does very well in the first half of a calendar quarter. So for the first quarter, January to March 31st, January 1st to February 15th tends to do a whole lot better than February 16th to March 31st. And so we have to be aware of that. Hold on one second. Okay, thank you. So we're getting closer to the end of that second half of the first quarter, which is good news because the first half of the second quarter tends to be very strong. So we're talking April 1st to May 15th. Well, we're getting closer and closer. Today's March 20th. So we got about 10 or 11 days, and then we move on to April. So I do think that there are brighter skies ahead, but right now the clouds are a little dark and could be some storms on the horizon. We'll see how we handle option expiration, or well, the day after option expiration, Monday. All right. Actually, let's look at the sectors here real quick before I switch into another page. So the financials led to the downside on Friday, down another 3%. It's been a brutal month of March for the financials. Real estate continues their downtrend, trending down below the moving averages, and now nearing a triple bottom around the 36 level. Real estate was down 2.3% on Friday. Industrials down 1.6%. They tend to move mostly in lockstep with financials. Financials and industrials tend to kind of go together, but obviously the banking issues were more specific to the financial area, but industrial starting to catch up. Dropped 1.64% on Friday, trading back down near about a 4-month low. Not looking great in the industrial space. Energy continues to weaken. As I mentioned at the top of the show, crude oil prices hitting levels we haven't seen since 2021. And then you've got materials falling back to about 5-month lows. You know, it's really difficult to be overly bullish energy and materials if you believe that inflation is not here to stay. These are groups that both these sectors were doing very well when energy prices were going up, when a lot of the material prices were going up. But now that that's changed, we've been drifting lower on both. You can see both the sector ETFs also drifting lower. So it's going to be a really interesting week because none of these groups that you see on your charts right here, none of these 5 sectors look very good to me. The good news is that the sectors that look the best are the growth areas. And I'll show you a chart in just a couple minutes, or summary, sector summary, showing you the massive difference between how the various sectors performed last week. It's really odd. We don't see it very often, but it was like a bull market was taking hold in some of the growth areas and a nasty bear market was in play in the value areas. Really, the bifurcation was astonishing. But anyway, we'll talk about that in just a minute. Let's move on to the 10-year Treasury yield. Get an update here. Right now, we're at 3.42%. It's been kind of a wild morning on the 10-year Treasury. Like I said, we were down at 335. You can see here we got up to a high of 345. Now we're back down to 341 and change. And we've got major support sitting right here. 340 from early December, 337. We did not have a close below 337 in January and early February, but we had that double bottom right there, really like a triple bottom. And we took off in the yield, and now we've fallen back apart again. Breaking down below these lows, I mean, there's some talking, hey, flight to safety. Everybody's getting into bonds, which is sending the yields down. I'm not so sure if it's that or if it's the inflationary expectations are dropping. Remember, this bank crisis is not good for inflation because when you've got the Fed funds rate going up, banks' borrowing costs go up. And when you've got the long-term side, the long end of the yield curve coming down, this impacts the revenue side of banks. So you've got, when the Fed raises Wednesday, if they raise on Wednesday, they're increasing the cost of business for banks. while at the same time, yields coming down lowers many banks' revenues. So if you've got banks that have shrinking revenues and rising costs, that's why you see something like this in the banking industry. So some are saying it's a flight to quality, flight to safety, which it is to some extent. But I think it's also when you talk about banks potentially lowering their earnings, I can tell you from having audited banks as a practicing CPA many years ago, banks tend to be very conservative. Most leaders of banks tend to be very conservative. Their board tends to be very conservative. They have a lot of regulation. You have the Fed come in, do their audits from time to time. They have to be very careful and they have to be safe and they've got regulations to follow, blah, blah, blah. Banks, if they start to struggle, they will cut their lending. They will not take chances. And if they start to cut lending, we're a debt-driven society. We need to borrow to grow. Whether it's borrowing money to buy a house, we expect that house to go up. Whether it's a business and you're borrowing money because you're trying to grow, we borrow money. And if the banks start to turn the faucet off, it's going to make it much more difficult. So, and I don't think this is a long-term crisis. However, in the short term, it's giving yet another reason for folks to sell. And as long as that's taking place and the VIX is rising, I'll show you the VIX. As long as that's taking place and we've got the VIX up in here, if we have another down day, you could see that VIX move back up into the upper 20s, maybe around 30 again. You start getting into the 30s on the VIX and the market can move down. I think this is the week. If the market's going to take a hit, and we've already taken somewhat of a hit, especially in the Dow and the S&P. Go back and look at the S&P 500. But you can see since that early February, especially middle part of February, that's where we've been trending lower. So we've already taken somewhat of a hit. But if we get a little nervous and the VIX, jumps up and the Fed kind of creates a little more havoc, which they've done a great job of doing, in my opinion, for the last year, then we could see another push down. And I think it could happen this week. I'm not saying we're going lower. Let me be really clear because a lot of people misunderstand what I'm saying. I am really bullish the stock market for 2023. I think long-term we're going higher, but I don't ignore short-term concerns and I don't ignore short-term historical tendencies that tell me that we're in a period when we can stumble. So in the short term, I would just say I'm cautious, not bearish. I'm not bearish. I'm cautious. It's okay to be cautious. You don't have to be, bullish and in fifth or sixth gear all the time. You can be bullish and recognize that, hey, we got something we got to deal with here. But I do think once we get past this week, things are going to look a little different next week. And as we begin to start thinking more and more about earnings going forward. All right. What else do we have here? So on the S&P, as I said, trending down, watch that trend line, watch the moving averages. That's going to be your key really back to the upside. We saw it on the NASDAQ. We haven't seen it on the Dow and the S&P 500. Here's the NASDAQ 100, right back up above the moving averages, PPO positive. AD line, by the way, on the NASDAQ, right back up near a 52-week, an all-time high. So look at all those hollow candles last week. So while things were a little rough the week prior, NASDAQ bounced back in a big way. Look, this is what I was talking about in terms of the bifurcation in the market last week. So technology up 5.7% last week. Communication services, 5.25%. Consumer discretionary, another aggressive group, 2.25%. Utilities, that's kind of weird to throw utilities in there, but utilities do love the month of March. We've talked about that all month. Utilities up 4%. Now, part of what's going on with utilities, I think, is that 10-year Treasury yield dropping makes anyone who's interested in income, if you're an income-oriented investor, now the long-term treasuries don't look quite as appealing, and maybe some of these utilities that pay nice dividends look a little bit more appealing. That could be part of what's going on here. But utilities having had a good week last week, and you can see these are the 6-7 groups that did well. And then all of a sudden you had industrials, materials, financials, and energy that absolutely got crushed last week. So that's what I was talking about in terms of bifurcation. A lot of times if the market's going up, you see everything go up to different extents, but everything goes up. Last week was not one of those weeks. Last week was a, hey, if you're a growth stock, we love you. If you're not, well, we're going to ditch you. And so watching the 10-year treasury yield this week, I tell you, if we break down the 10-year treasury yield, get past this week and start focusing on earnings, we could see a big run up in the NASDAQ, and especially those growth stocks. We shall see. All right. So in the news today, one thing that was in the news is FRC. Of course, that's been in the news for a while, but the stock down another 18%. Well, let's get the latest, because that was as of just a little while ago. Yeah, still 18.5% down on FRC. So it looks like some of the banks are likely to be hit again. UBS over the weekend came out and said, hey, we'll buy Credit Suisse. That's the good news. UBS, the market's saying, okay, we like this deal. 3.8% higher on UBS. But what about Credit Suisse? Well, Credit Suisse had a market cap of almost $8 billion. And I believe the offer was 2.3 billion. It was 2.3 or 3.2. I might have them mixed up. But the point here is the offer was much lower than where Credit Suisse closed last week when it was at $2.01. So you wake up this morning down $1.10. Your company's being bought out. Oh boy, what kind of premium did I get? Well, you didn't. You actually got cut 55%, probably giving you a signal of how bad off Credit Suisse is. You might be thankful you got 55, or you only lost 55% from Friday, because if that's the buyout price, I mean, there are a lot of other banks that could have bought Credit Suisse. UBS stepped up, and apparently, based on what the market's saying, they got a sweetheart deal, buying in cheap to restore liquidity and to help out the entire banking system. So long term, I think this is a great thing for the banks to have some of the big banks step up, kind of eliminate the liquidity issues. But obviously, if you're in these individual banks that have been struggling for the past 2 weeks, it looks like it's only getting worse today. Enphase, they got upgraded. I'll tell you, this is a stock that has been beaten up. We were talking about $340 a share in December, and we've had a really good run this year in growth stocks, but many of these solar energy stocks not really participating. And Enphase down almost 9% on Friday, breaking down to new lows. And now you've got the upgrade and the stock up 2%. I'm not sure. I mean, we could get back up to 195 to 200 on this chart, but as I see it, Enphase had a positive divergence. If you look, here was the lower prices, higher PPO. What I always talk about is centerline PPO centerline test, 50-day test. That's what I look for when you get a positive divergence. Maybe we keep going, but maybe we don't. This is where we reset. So what this is telling us is we have slowing momentum. Well, when you get back up to the 50 and you get your PPO back to the center line, there's no momentum. Zero, the PPO at zero means there's zero momentum when you look at the short-term moving average versus the long-term moving average. And the PPO, the default is based on the 12-day and the 26-day EMAs. So when you get to zero or close to zero, your shorter-term 12-day moving average and your longer-term 26-day moving average are equal. In other words, there's no momentum. Short-term isn't above long-term. Short-term isn't really below. Well, it's a little bit below. So maybe they're still slightly negative or inverse selling momentum. But this is what I look for. Positive divergence, we get a test of the 50, we get closer to the zero line on the PPO, and then we look to see what happens next. Well, Friday, we found out what happens next on end phase. It breaks down again. So instead of this positive divergence being the start of something big to the upside, it actually was just temporary, hit the 50, and now we roll over. Now with that breakdown to new lows that we haven't seen since July of last year, we get an upgrade. So we're up a little bit. I think if we get back anywhere near 200, especially, I mean, if we could climb up near that 20-day moving average, I would be very, very careful at that point. All right. Talked about UBS. So there's UBS. And actually that one, as I said, is actually up 3% now, I think. 4 actually continue to move up. So up 4.5%. Want to talk about chart of the day. So every other day, Monday, Wednesday, Friday, we do our earnings beats digest. And today's chart was Dynatrace. This is a stock that had gapped up with its earnings, came all the way back down here into this gap support zone. So this is a chart that I'd written a couple of paragraphs about. And if you are a EB Digest subscriber, it's free, by the way, no credit card required. And you can unsubscribe at any time. Those who have the EB Digest will be getting, or probably have already gotten, your article for today, which features Dynatrace. And I just talked a little bit about this relative to some of the other software stocks, how software has been doing, and the fact that we're now all the way back down to what I call the scene of the crime. And there's really no crime, but it's where we had been before earnings came out. So we gapped up, went all the way back down as if the earnings report and the gap up had never occurred. Usually that's a pretty decent time to get involved in the stock, but I talked a little bit in the EB Digest article about the reward to risk ratio and where I'd be looking. Anyhow, just wanted to mention this. If you are interested in joining, you can go to Earnings Beats. And if scroll down, we have a free newsletter right there that you'll see. Just a name and an email address is all it takes. And hit that subscribe button. We'd love to have you. All right. We got about 8 minutes or so before the market opens. I wanted to talk a little bit about historical trends. So I've put a chart in here, the S&P. And if you go down here, you can add extra bars. And when I add extra bars, it just brings out the next 20 trading days, and it just leaves the price action blank. So I'm looking at what I think might happen. I mean, this is just a guess. We could do anything. We could just take off. We could break down. We could pull back and then take off like I've shown. The market can do anything it wants. But part of planning is knowing history. Part of planning is understanding where we are technically. Part of planning is having conviction. I mean, I'm bullish, but you don't have to be bullish. There are plenty of folks out there that are bearish, think we're going lower, think we're going to take out the October low, and we're going to go a lot lower. And that's okay. There are two sides of the market. You can believe whatever you believe. But if you don't have conviction, then you're going to get whipsawed. And conviction and stubbornness are kind of, there's a fine line between the two. And I know some of you, I talked about being bullish back in June of last year. Well, we are still up a little bit, but some of you think, hey, he's just always bullish. No matter what happens, he's always bullish, which is not the case. I was very bearish first half of 2022 when the market was coming down. I was one of the first to get bearish. But once we got to that bottom in June, I called a bottom. We don't really, I think we had maybe 5 closes below that level since June of last year, and we are still trading above it. So I think that being long has been the right call. If I had said, hey, you want to keep selling? Well, I mean, the market's higher than where it was. Wouldn't have been a great call. So anyway, I'm bullish. So I'm thinking from a bullish perspective. What do I see? Well, you have to understand history first. And I'm going to read you the annualized returns of the 19th through the 22nd of March. Now, the 19th, of course, was yesterday, but the 19th through the 22nd of March, historically, since 1950, the annualized return on March 19th is minus 33%. The annualized return on March 20th is minus 19%. The annualized return on March 21st is minus 21%, and March 22nd is minus 17.8%. So these 4 days come out to an annualized return of minus 22.82 days. And this covers 207 trading days dating back to 1950. There have been 207 trading days that fall between March 19th and March 22nd since 1950. And of those 207 days, 90 go higher, 117 go lower. So that's a 43.4% chance of one of the days in this period going higher. That compares to 53.5% of any day throughout the year going higher since 1950. So you can see there's a tendency. We're 10 percentage points below average in terms of the chance that one of these days is going to be higher. Does it say 100% of all the days go lower? No. It says 43% go up, so that means 57% go down. It's not a slam dunk. It's not 100%. It's not what I'm saying. It's like, you know, one of my I guess childhood idols. I was a big baseball fan, Major League Baseball fan. I loved the Baltimore Orioles. Back in the day, in 1960s, 70s, they had great teams. And Earl Weaver was the manager. And Earl Weaver was the first manager to start using statistics in platooning different players. He'd do right-handed batters against certain pitchers, but then if it was another pitcher that was pitching, he might have a left-handed batter inserted in the lineup. So he would platoon the outfield. And then he also he was the first one to start bringing relief pitchers to match up against certain hitters because they had a great track record. Didn't mean that they got them out every time. It just means that historically they had fared really well. So he went with the odds. And a lot of what I do in the market, I always think back to Earl Weaver because all he was doing was trying to improve his odds for success. He didn't have a guarantee. And so historical analysis is not a guarantee. It's just giving you another leg up on everyone else that doesn't understand history, that doesn't realize that the middle part of February to the end of March is the worst part of the quarter. And that the first half of the quarter is the quarter you want to be in. Look at the last big move we had. July to August 15th. There's the first half of the quarter. Here's the second half of the quarter. Now, trust me, it's not always that blatant, but, you know, here, start of the first quarter or the first half of the next quarter. Now, this actually, historically, the fourth quarter doesn't work as well because the second half goes through the holidays, the Santa Claus rally, and actually is not a bearish period. But the first 3 calendar quarters do tend to operate like that. We're getting close to the start of the next quarter. Now, again, does it guarantee us we're going higher? No, but it's a trend, historical trend that we need to be aware of because it helps improve our odds. Anyhow, I could see here over this week, maybe in the next week, going back down to 3,800, maybe even this gap support level, 3,750. That would definitely scare a lot of folks if we break down. I think it's possible. Do I think it's 100% guarantee? No. I would probably 3,750. I would put maybe a 15 or 20% chance. I don't think it's going down that far, but I think it's possible. Do we get to 3,800? I'd maybe say there's a 25% chance of that. Maybe 30. I don't know. But once we get past this week, I am going to be much more bullish. All right. The Mondays, the other thing is the Monday after option expiration only goes up on the S&P 500 37% of the time since 1950. So it's down 63% of the time. Again, it's not a slam dunk 100%, but Monday after option expiration usually is not good. We'll see what happens today. We get toward the end of the week, we get past the Fed. If rates are still coming down, the 10-year Treasury, we're setting new lows there. I could see the scenario, the backdrop for another big move to the upside. We'll see what happens. All right. Earnings spotlight. Just wanted to give you Foot Locker, which reported this morning. Foot Locker easily beat 97 cents versus 52 cents. Oh, I think the market has just opened, so I'll give you this. And you can see a big gap up there trying to make a breakout. It did open below resistance, though. So what I would be careful about is a move up intraday to new highs that fails. So the fact that it opened beneath resistance, for me, if I happen to be lucky enough to be in it, which I'm not, but if I was, I'd probably take my money and run. I don't like the gap ups below resistance. I like to see the gap up above resistance. And so we'll see what happens here today on Foot Locker, but just be careful if it breaks out and doesn't hold. And by later this afternoon, if we're back down below 46, that would not be a good look. Just to wrap up here, the last couple charts I'll show you, some earnings that will be coming out, some big earnings that will be coming out later this week. We got Nike. So Nike, let's get a relative chart. AD line looks good. It's back above the 20-day. It's in a pretty good area. Here's footwear relative to the S&P. We had a strong fourth quarter and start of the first quarter, went down, and now it looks like the group is starting to turn back up again. Nike has done okay relative to the S&P. It's versus its footwear peers, it's actually been an underperformer. And now for the last 5-6 months, more of a steady performer. So anyway, Nike's going to be reporting. That'll be interesting for the entire footwear group. Chewy reports on Wednesday. Nike comes out tomorrow, by the way. Chewy reports on Wednesday. AD line's been pretty strong, but price action's been struggling below the 20-day moving average. And as we look at relative strength, Chewy relative to the specialty retail has just been going along for the ride. Not really a leader, not really a laggard. The overall group has been strong, although it has struggled the past 3 or 4 weeks. So kind of maybe a coin toss on that one for me. I'm not sure what to expect there. Also reporting on Wednesday, last one I got for you here, KB Home. KB Home in the home construction area, the group home construction, you can see it turning back up again, and look at it relative to the S&P 500, a new 52-week high. So the group is strong. You're going into an earnings report, a company within a space that is very, very hot right now. And if long-term Treasury yields keep moving down, that's kind of a barometer for mortgage rates. That would certainly help KB Homes, but it is not one of your better home construction or home building stocks. So mixed here. I'm bullish on most of the home builders. I think this one is KBH just an outlier and it's going to have bad numbers, or does the strength of the overall group bring KBH up when they report on Wednesday? We're going to find out. Anyhow, let's take a look, see what is happening in the market right now. Well, the Dow's up 237, S&P's up 14, the NASDAQ, though, is down 21. So we got bifurcated action. Remember last week, everything was growth, everything growth related going up, everything value related going down. Well, we're starting off the week reversing and doing the exact opposite. So it'll be very interesting to see. S&P 500, you can see the leaders to the downside there. Nothing really major other than FRC, which is, again, having a rough start. And then looking on the other side, best performers on the S&P 500, a lot of financials getting off to a good start this week. Anyhow, that's it for me. Everybody have a great day. I'll be back tomorrow morning. Go over to Stock Charts TV at 9 a.m. and just click on this link, and it'll bring you right in. You don't have to be a member. You'll just be able to check it out. So check out that show tomorrow on Wednesday. I'll be back here. I want to thank everybody for signing up and subscribing to our YouTube channel. This YouTube stream has actually been gaining some strength, so make sure you tell your friends, family, anybody you know that is interested in the stock market. We try to make this as educational as possible. We try to teach about the market, try and help you in your financial journey over the next many years. So be sure to subscribe, hit the like button, and have a great day. See you tomorrow. Happy trading.